This video gives a brief introduction to the bond. So first, a bond is a debt. So you issue a bond as if you borrow from the bank. But the difference is the bond is tradable. So if I purchased a bond from Microsoft, I can sell it to someone else. But the debt, if you borrow debt from Bank of America, you cannot. Bank of America would not be able to sell your debt to some other banks. So bond is a public debt. You can trade it at a market price. And also in comparison to equity, bond bears less risk. So the bond is generally protected with either collateral or a senior obligations. That means the bank, the company would have to pay off the obligations of debt before they pay any equity, like a dividend. The investor purchased the bond in exchange for the interest payment and the principal payment. So pretty much you are the lenders if you purchase a bond from a company. That gives you the entitlement to receive the interest and the principal. And usually the interest is paid periodically every year or every 6 months. And the principal of the bond will be paid off by the end of that maturity. So for example, if the bond has 10 years of maturity, then you will receive the periodical payment of the interest every, let's say, 6 months from year 0 to year 10. And by the end of year 10, you will have the principal payment. Okay? And this is a U.S. Treasury bond that was issued in 1979, and matures in 1994. And it's 15 years of maturity. And you can see this is the interest rate that the government is going to pay you by holding this bond. It's 10 1/8%. That is considered very high because at that time, in the end of 1970s and early 1980s, the interest rate was very high. Okay? And this is a corporate bond issued by a company called United Aircraft Corporations. Okay? So basic feature of the bond. The bond is a fixed income security. So as we said earlier, it pays a fixed amount of interest periodically to the holder of the record. The corporate bond is a form of public debt, and there are 3 intrinsic features that's related with bond. The first is coupon. Now the coupon is a finance term, so it determines the periodical interest income. So let's say in the previous slides, 10 1/8% is the coupon. That means the government is going to pay you 10 1/8% of the face value as an interest every year to the holder of this bond. So face value is obviously how much the company or the government owns you. It's usually in the number of $1,000. That's also called principal. Okay. And the second is term to maturity. That means how long you can hold the bond. What is the period of time that the company borrow money from you? So for a bond, it usually starts from, let's say, 2 years, 3 years, 5 years, 10 years, 15 years, 20 years, and 30 years. The bond with the longest maturity is the one that is issued by Disney. It's called a Sleeping Beauty bond that has a maturity of 100 years. Principal is different from the market value, and the common principal, or we sometimes call it a par value, is $1,000. That means how much money the bank or the government has borrowed from you. So for example, this corporate bond issued by United Aircraft Corporation has a face value of $1,000. Okay. Now let's look at the bond cash flow. So this is an example, has a bond with a principal of $1,000, 4% of coupon rate, and a semi-annual payment. That means the coupon will be paid out every 6 months. It matures in 2 years. So the face value is $1,000, 4% is the coupon rate. That means the company is going to pay 1,000 times 4%, that equals $40 per year for using your money. And because of the semi-annual payment schedule, the $40 were paid out to you in a 6-month interval. So here is a timeline of your cash flow for the 2 years. So in the 6 months of time, you will receive the first payment of the coupon that's $20. In 1 year of time, another $20. In 18 months of time, another $20. And by the end of year 2, you will receive the last coupon payment that is also $20 plus the principal. Principal is $1,000. So this is your payment schedule. And keep this in mind, we will use this payment schedule to evaluate the bond. Another example is a bond with a principal of $1,000 but 8% of coupon rate. Still the same annual payment and matures in 6 years. That means every year you receive $1,000 times 8%, that's $80. But this $80 under the semi-annual payment schedule will be paid to you $40 every 6 months interval. And for the 6 years of time, you'll receive 12 installments of the coupon. So the first timeline is the coupon payment, which you will receive $40 every 6 months for 12 times. And this is actually an annuity. The second is the principal payment. You will not receive any principal payment until the end of the 6th year. That's $1,000. And combine them together, this is our total payment. We'll receive $40 every 6 months for the previous 5.5 years. And by the end of the 6th year, you receive the last installment of the coupon payment, $40, plus $1,000 of the principal.